Last chapter of Module 3, Chapter 10, Operations Budgeting. And once we have this, you're going to have your third test, and then you're on your last chapter, your last module, which is Chapter 11, and we'll be through. So we have the competencies of this chapter. Of course, you need to describe the purchases of budgeting and identify the roles and responsibility of those involved in the budgeting process, and explain the process of preparing an operations budget, and describe the budgeting control process, and explain significant variances or how significant variances are determined, and to use information from budget reports to calculate and analyze several kinds of variances related to revenue, cost, volume, and labor. And we're not actually going to do that this semester, and describe the proper management response to the results of variance analysis. So we're actually not going to do variance analysis in this course. I may add it to 467, but right now I just don't see it as important as other topics that we cover. So we need to figure out how to prepare an operations budget, and we're going to actually look at both budgets for hotels and restaurants, and there are some differences, and there are a lot of similarities as well. So first we need to establish our financial objectives, and those hopefully are in a net income way. So we need to determine if we're going to make money or lose money, or if we're going to break even. And then we're going to forecast revenues and estimate expenses. And then we're going to determine the bottom line. And if the budget is approved, we're done. And if not, then we're going to go ahead and have to do another one. As an example, when I was running restaurants, I would require my departments to do schedules and other budgets, and schedules would be a labor budget, and if they use too much labor, I'd have them go back and rewrite the schedule. When I was running a casino and I had 5 different profit centers, each profit center had to calculate their own departmental budget, and once they were approved, we moved forward. So first thing we need to do is we need to look at a restaurant, and the main difference in forecasting for restaurants and hotels is how we project our revenues. So for a hotel, if you look, we have rooms available times occupancy percentage multiplied by ADR, which is average daily rate, or the average selling price of a room. We multiply that by our projected days, which is usually 365 days, because we're usually doing annual budgets, and that gives us our forecasted revenue. For a restaurant, we're going to take our total seats and we're going to multiply it by 0.75. The reason why we multiply it by 0.75 is because when your restaurant's full, you're usually only using about 75% of your seats. If you think about it, you have some 6 tops that you have 5 and 4 people in, and you have single people who come in and sit at tables for 2, and the tables for 4 don't always have 4 people. Sometimes you put 2 there, sometimes you put 3, and if you have to, you put 1. So even a full restaurant is only about 75% full. And then we have projected turns, and what that is how many times you're going to refill your restaurant. And usually what happens is most restaurants will have more turns for dinner than lunch. As we talked about in previous lectures, though, restaurants like McAllister's and Newt's are going to have more turns during lunch than dinner. So we're going to take seats times 0.75 times our number of turns, multiplied by the check average, multiplied by the projected days, and we get our forecasted revenue. And then we have different types of costs. Of course, we've got variable costs and fixed costs. And in these examples, even though we have looked at mixed costs, we're not going to look at mixed costs because we're just doing forecasting. And hopefully we have revenue at the end, or net income at the end. Okay, so here's a restaurant example. I know there's a lot of words up here. What I do whenever I'm tackling a problem like this is I go ahead and I put together a sheet and I identify what everything is. So in this example, we have lunch and dinner in this restaurant, and the lunch and the dinner check averages are different, and the table turns are different. Okay, so for lunch we have a $12 check average. For dinner we have a $17 check average. We have 175 seats, which doesn't change. For lunch we hope to have 2 table turns, and for dinner 2.5. We're open 7 days a week, so we can use the 365 days in the year. And on our menu mix, we expect to have a 34% cost of sales for food and beverage, which is a variable cost. And our management labor is $160,000, which is a fixed cost. And our hourly labor is projected to be 25%, another variable cost. And then we have other variable costs of 16%, and that's going to be things like linens and cleaning supplies and such. And then we have another fixed cost of $200,000, which is probably our rent. And our taxes are 25%. So the first thing we do is we calculate our revenue. So what I've done is I've done the entire sheet here, and we'll go over it line by line. And I have our revenue, and I have our lunch, which is our check average times our turns times our seats times 0.75. So that would be $12 times 2 times 175 times 0.75 times 365, and we get a little over $1 million. And then we do the same for dinner, and our total is $3,185,765.63. So our dinner numbers, our check average was $17 times 2.5 turns, so 2.5, and the seats were $175. Now we do our cost of sales, and our percentages are always our percentage of sales. So we're going to take total sales and multiply it by 0.34, and we get $1,083,160 and change. And then we do our labor and our management. We had fixed costs of $160,000. We have our hourly labor, which was 25% of sales, which is almost $800,000. So we just took our total sales and multiplied it by 0.25. Our other was 16%, so we take our total sales and multiply it by 0.16. Then we had additional fixed costs of $200,000. So then we add all of our expenses up from the cost of sales all the way down, and we get $2.7 million and change. Our income before income taxes is our total sales less our total expenses. So we took the $3,185,765.63, and we subtract that out to $2,749,324.22, and we get $436,441.41, and then we multiply that by our tax rate of 25%, and that gives us our income tax of $109,110.35. And we subtract that out to find out our net income, and that is $327,331.05. So again, our revenue calculations are going to be different when we forecast for a restaurant and a hotel. Hotels do not have cost of sales. We could actually separate our cost of sales into food and beverage, but we're not going to do that for this course. I'm actually going to have y'all do that in 441. So hopefully you'll remember this when we go into NHM 441. All right, so here's another long paragraph telling us about, oops, that's the same one, isn't it? Okay, I'm sorry. Here we go. So here's our hotel forecast, and we have an average room rate or ADR of $125. We have 55 rooms. We're open all year long, every day of the year. And we have an occupancy percentage, and we're hoping to achieve a 75% occupancy percentage. And then we have our costs. So that's how we calculate our revenues, with everything above the 75%. And then our hourly labor is 11%. Our management labor is $35,000 a year. I hope that you're not the manager only making $35,000 a year. Our other expenses are projected to be 19%, and our rent is $45,000. Finally, taxes are 35%. So we take this information and we plug it in, and we take our 55 times our ADR times our occupancy percentage times our days, and we get $1.8 million in change. Our labor, we have 11% of sales, so we take that $1.8 million in change and multiply it by 0.11, and we get $207,023.44. Our fixed cost, our management fees, were $35,000. Our other costs were 19% of sales, and that's $357,585.94, and that's everything from lights to the room furnishings, you know, the soaps, and if we do breakfast, the breakfast would be in there, and on and on. And then our rent was $45,000. So when we add up the total expenses, both fixed and variable, we get $644,609.38. And then our next line is our income before taxes, and we take our revenue and we subtract out our total expenses. So we take the $1.8 million in change and we subtract out that $644,000 number. We get $1.237 million, $1,237,421.88. And then we determine our taxes, and our taxes are 35%. So we multiply that $1,237,421.88 by 0.35, and we get $433,097.66. And then we subtract that out, and we get our net income of $804,324.22. I guess I have these in the wrong order. So here's another, oh, I see what I did. I apologize. This is a problem for you to do, which was different than the other one. And then we go down, this is a new problem for you to do different from the other one. And I'll give you those solutions in a solutions video. And for the budgetary control process, we've kind of talked about this. We have variances that we need to determine our variances. And we do that by looking at our actual from our budget, and then we find out where there's significant variances, and we're going to analyze those and find out where they're coming from or why we have significant variances. Examples of that, let's say that we had a budget food cost of 32% and it came in at 36%. We'd find out where that 4% went, and we could do everything from separate our food costs into different proteins and such, and find those variances and find the problems, and then we go ahead and take appropriate corrective action. We may go ahead and do a perpetual inventory of meat. We may lock up our meat at night. There's other things that we could do in hopes of bringing that food cost back in line. And you're just going to see multiple choice questions from the budgetary control process, and you may want to read about this in the textbook to get a little bit more clarification. And that's it for the chapter. So going back, let me just go back. You have two problems. I gave you an example for the restaurant right here, and that was a solution. And then I gave you another problem right here that we'll look at in a solutions video. And then I gave you an example of the hotel, and I gave the solution to the example. And then I gave you another hotel problem that you're going to need to do and look in the solutions video. So that'll actually be homework you need to turn in. You're going to need to turn in the restaurant forecasting problem and the hotel forecasting problem prior to being able to look at the solutions. And then you have the budgetary process, and we are done.